one thing I'll say that will probably be controversial, some of these analysts are using a different valuation for every company. They use this valuation for the company they don't like, and they use this valuation for the company they do like. If they actually used that methodology on our company, we would actually have more upside than the company they're recommending. That's crazy. And they get away with it. Not acknowledging the growth rate of one company versus the next is just idiotic.
I finally had a chance to sit down and talk with the man himself, Anthony Noto, the CEO of SoFi Technologies. As many of you know, I've been covering SoFi stock for over 4 years now. I've stuck through it as a believer through the highest of highs and the toughest of lows. From the student loan moratorium to the rapid raise in interest rates, I've always entrusted Anthony to navigate these tough waters. So getting to pick his brain directly was a massive milestone for the channel. We discussed how he views this current landscape and where he sees the company going next, and I really appreciate his level of transparency and the fact that no question was off limits whenever it came to our conversation with Anthony. So once again, a huge thank you to the entire SoFi team and for Anthony for his time, and I hope that you guys get as much value out of this conversation as I did. So please enjoy this conversation with Anthony Noto. Anthony, thanks for joining us. It's been a long time coming for sure.
Well, it's my pleasure, and thank you guys for having me, but also just thank you for all the incredible work you do to help people and stay informed about our great company and provide perspectives that help people make great decisions. So very much appreciated.
Yeah, absolutely. I mean, but I want to make sure that we jump through because I have so many questions and,
Sure.
and so little time comparatively. But you guys have recently done 2 capital raises, I think a total of $3.3 billion. You recently put out a blog post today on the sort of choice between inorganic and organic growth. Can you speak to that for us?
Sure. Well, first on the capital raise, I would definitely encourage people to go to our investor relations website in our area within our website. Provides a really, I think, detailed perspective and one that will dispel many of the myths. The first thing is like our goal is to build long-term shareholder value, and there are a lot of different ways to do that. Capital is critical to all the ways that you drive shareholder value. And I know there's a fair amount of people that believe a capital raise is dilutive. We wouldn't do a capital raise if it was dilutive to the company because that would destroy value over time. And so the accretion that comes from the capital raise should be incremental, and it should be incremental over time. It so happens that the position that we're in when we raised capital both times was accretive to tangible book value per share. Mm-hmm. If you think about financial institutions, at the essence of it, the company's at least worth the difference between their assets and liabilities, and subtract goodwill from that, and that's tangible book value. Well, you can increase your tangible book value by doing an equity offering. It's unusual to also increase your tangible book value per share, but we are able to do that, and that gives us great flexibility to be able to go down whatever growth path we're considering. Gives us great flexibility to opportunistically buy something that we think is strategic and could help us accelerate our growth. Also allows us to reduce our expenses, specifically our cost of capital based on debt expenses. And it does generate income, even if the cash is just sitting there, based on where interest rates are relative to as we think about our other costs of capital. So 100% opportunistic. We wouldn't do it if we didn't think it was accretive over the long term, but this happens to be accretive to tangible book value per share in the near term.
Could I quickly speak on, you said a lot of financial institutions are at least worth their tangible book value. What makes SoFi worth more than their tangible book value? And what gives you sort of that fintech valuation?
Sure. We'll be worth more than our book value if we can drive high returns on equity being your book value. And we believe we can drive between 20 and 30% return on tangible equity. We're not there today, but we've laid out the sort of building blocks to get there. The first is EBITDA margin, which is directly how much do you generate in profits per dollar of revenue. And as you know, our most recent quarter, we've been right around 29, 30%. And we've committed in the future to invest back into the business at least 70 cents of every incremental revenue dollar, which is a 30% incremental EBITDA margin. Our EBITDA margins have, shown the ability to be much higher than 30%. And so long-term, that will be somewhere between 30 and 40%. then obviously you have to consider the expenses below EBITDA to get to a net income margin, which would inherently be the numerator in the return on equity calculation. So today we're not at our normalized level of return on equity, but we're showing you the building blocks that will indicate that we can get to 20 to 30%. If you look at companies like American Express, they have traded between 4 and 7 times in the last 12 months their tangible book value per share. And the reason why they trade at that high multiple of tangible book value is because they have return on equity of over 20%. So there's a direct correlation between return on tangible equity and the multiple of book value. Now, you don't have to value our company off of tangible book value. It's just a point of comparison. And I would say it's the point of comparison to the worst way to value the company. I think a better way to value the company is off of our earnings and our growth rate. And so when I covered internet companies back in 2000, from 1999 to 2007, it was really hard to value companies like Amazon. Everyone wanted to value Amazon like a retailer at like 1 to 2 times revenue. And that would translate to like 20 times earnings at a normalized margin over time. And so one of the things I did was really relied on PEG ratios. And so I looked at what is the price to earnings to growth rate ratio, PEG ratio. And I would use a 3-year normalized growth rate, not a growth rate that was super high relative to revenue. Some companies are driving 30% earnings growth, but only 15% revenue growth. That's not sustainable. Once you hit your maximum margin, your earnings growth will reflect your revenue growth because you can't drive margin expansion. So I never used a growth rate in earnings that was more than 5 points, 500 basis points, 5 percentage points of growth faster than the revenue. If you look at SoFi, we've told the street that we will grow our earnings 40% over the next 3 years. And we've also given a revenue growth number. Well, if you look at the PEG ratio broadly of the market, it's around 1.4 to 1.5 times forward 3-year growth. Financial services companies and fintech companies, they trade at about 1.1 times forward 3-year growth, which would imply a 44 multiple of earnings. And if you apply a 44 multiple earnings to our earnings in 2026 and 2027 and discount them back to today or 2028 for that matter, you'll see that the value of the stock is in the 30s today, and a year from now approaching 40 to over $40 a share, depending on what discount rate you use. So we have to deliver on the growth, and I believe if we deliver on the growth and return on tangible equity, the multiple will reflect that.
It's interesting that you guys posted record results for Q4, and since being a public company, you've beaten and raised every single quarter. We on the other side can only go off of the guidance. I'd love to understand a little bit more about your guidance philosophy. I think one critique that we often get is that guidance is on the safer side, at least for the first half of the year.
Yeah. So one of the things to think about from a guidance standpoint, having been a research analyst, but also having been a CFO, 2 times, one of a public company, one of a private company, is financial services companies are very different than other sectors from the standpoint that your brand that reflects your company, it reflects its morals, its character, its culture, it's what I would say, these intangible things all have to triangulate back to trust. And if people don't trust us, they're not going to give us their money. And so when we're giving guidance, it's not just about what can we deliver to the financial community and to our shareholders, but it's also considering reputational risk and brand. And are we building a brand that people can trust, that people can rely on? And we have to be a brand that people trust. So when we're giving guidance, I'm also thinking about that. I never want to miss what we tell someone we're going to do. Because if we do miss what we tell someone we're going to do, then we're eroding that brand, we're eroding that trust, we're eroding that culture that we're establishing. And so that's not to say that our guidance is sandbagged. It's just meant to say it's a responsible guide, not an irresponsible guide. I see other CEOs on Twitter and other places being very, I don't know what the right word is, very Hollywood. And they're very, they boast and they make grand statements. You can't do that as a financial services company. Who wants to give their money to someone that wants to be in the glamour world, wants to be in Hollywood, wants to, make these huge, grandiose, statements and not be able to deliver on them? So I believe we have an obligation to our shareholders and to our members to be reasonable. It's not to say we don't take any risk. We always take risk, but we want to make sure what we tell you we can deliver. So, and it's not meant to be sandbagging. So, for example, our guidance for 2026, we're guiding to 30% revenue growth plus, 30% revenue growth plus. And in the first quarter, our revenue growth is 35%. I would be incredibly disappointed if we didn't deliver, if the first quarter of the year was our fastest growth quarter of the year. I would be disappointed if that's what happens. But here we are in February, giving guidance for the next 12 months in the world that's shown no one's very good at predicting the forward 12 months in any of the last 5 years. Interest rates have turned out to be different than people have thought. Inflation has turned out to be different than people thought. We had a global pandemic. We had a president that basically wiped out the student loan refinance business. We have global issues and risks. We have a war in the Ukraine. So if we're going to give guidance for 12 months, which is you only do that once at the beginning of the year, you have to have a balanced view that say we have to have an expectation that we can deliver this unless something deviates meaningfully relative to the conditions that we're assuming. So we have a lot more visibility on the first quarter. So our growth in the first quarter happens to be greater than the rest of the year. And that's because the rest of the year is more uncertain. But I would be hugely disappointed if Q1 was our fastest growth quarter of the year.
And I can ask about that with regards to the guidance, just because we're on that topic. How sensitive would that guidance be towards rates? I mean, let's just say rates are not lowered at all in 2026. Like, what implications might that have on the guidance?
Sure. And our guidance, when we gave it to the street, Chris walked through what was assumed in our guidance. And I believe what he said was 2 rate cuts. I would tell you, I believe our business is diverse enough. Our management team is nimble enough. We're good allocators of capital. We're good allocators of resources and changing those allocations based on the conditions. So if rates didn't change, I believe we could still achieve our financial outlook and our guidance. We will achieve it differently than what we have planned. We didn't actually lay out for you exactly how we're going to get there. But since I've been here for the last 8 years, rates have always turned out to be different than what we've thought. And as that reality has come to bear, we make different decisions. I'll go back to 2019. There was supposed to be a bunch of rate increases in 2019. And we took a stance that as those rates increased, people would be looking to refinance their student loans. And as they would do that, we would be able to capture that opportunity. Well, we got to 2019, and there was only one rate cut, I believe. And so we had to completely pivot to personal loans, which is what we did. So every year the rates turn out to be different than we think, and we have to operate within that. What I would tell you is our guidance really reflects just a stable economy, stable situation. Rates could be flat, rates could be up a little bit, rates could be down a little bit, but it really means that we can operate and achieve our guidance in a stable economy. If there's some disruption or big instability, then we'd have to revisit all of the assumptions that we have. But if there are no rate cuts and we still have a stable economy, unemployment's below 5%, we'll either achieve or exceed our financial expectations.
I want to speak to the loan platform business, which I think has just completely changed the way that I view the company. Can you tell me, even in this changing rate environment, how do you know to eventually go into the loan platform business for home loans, for example? Because that's another area that you've been talking about a lot and massive markets there. But what is stopping you guys from entering that market sooner? I'm just not in that space, so any clarity would be great.
Yeah. And the loan platform business is a piece of our strategy. I think some people started to believe it was the only strategy. It's not the only strategy. Loan platform business really came to life when we looked at what are the areas that we're not capturing value for our members and not creating value for our shareholders. And we declined 70% of the applicants for personal loans. And that seemed like a big opportunity. We also kind of gated our marketing based on how much we wanted to put on our balance sheet from an asset standpoint and versus how much we could sell as well. And so we knew there was more demand in our credit box for our loans. And we obviously know there's demand for our loans outside of our credit box. And that was the birth of the loan platform business. And so think about that going in a couple different directions. The nearest term direction is actually doing loan platform business loans for partners outside of our credit box, what we call credit expansion. And so we're working on that now. It's a priority that will continue to have an impact on our results in 2026. The second area is what you alluded to, which is going into other products, other loan products. The most likely next loan product is actually student loan refinancing, and then potentially in-school loans, and then home loans, but home loans of a certain size. So home loans today are largely agency loans. And if you think about an agency loan, we're allowed to put that loan to the government agency mortgage companies in a similar way to the loan platform business. If we produce the loan according to their formula, their recipe, we know the price they'll pay for that loan, and it's off our books within days. So a big portion of the home loans market is already like loan platform business. There will be some segments of it that we could do the loan platform business in, but I think expanded credit is much bigger opportunity, and student loan refinancing is a much bigger opportunity than LPB for home loans.
Yeah, that makes a lot of sense. You also spoke on guidance and how hard it is to guide for 2026. One of the potential new products that you guys are looking to get into is small to mid-sized businesses, big businesses, or big business banking. How does SoFi differentiate to potentially solve the problems that those businesses are having? How do you attempt to win in that area?
Yeah, so I'd like to focus on big business banking. We could talk more about small, medium business banking if you have other questions on that.
Yeah.
But big business banking, actually, the idea came from us talking to partners. There are many crypto companies that are quite sizable that are not banked by the large banks, and they have to use a sort of aggregation of smaller banks. And no one really does fiat and crypto, stable coins, et cetera, at scale. There was a company that had done this in the past, but unfortunately, they had issues and the bank was closed down. And so that's where the idea came from. And since then, I've only gotten more excited about the idea. And we want to be the bank for the biggest companies in our country and the biggest companies in the world. We even want to be the bank for other banks. And the differentiation is that we can do both fiat and crypto. We have a technology platform that we can leverage to deliver that. And I'm super excited about it. It'll be very different than SoFi Money from a revenue diversification standpoint. First of all, the revenue is being generated by corporations, not by individuals. And that has some characteristics that are really attractive. Your cost of funds are very low. In addition to that, it's a fee-based business. We will charge fees of companies for the activity that we do for them. In SoFi Money, we don't really charge the consumer anything to use the SoFi Money account. Now, we do charge for things that are, very, very valuable and very differentiated, like self-serve wires. I don't know if you guys have ever done a wire or you've done a wire on SoFi, but I can tell you the self-serve wire experience on SoFi and SoFi Money is infinitely better than any wire experience I've done in my entire life. And so that's one of the few things that we charge for in SoFi Money. But in big business banking, we'll charge for transactions, we'll charge for bill pay, we'll charge for wires. We may have a subscription service fee to even have an account. And so it's going to be a very attractive business to us. And I think it'll be a very consistent business. And there's really not a bank out there that's doing it today. And I quite frankly don't think there's a bank that could do it the way that we can. One of the things I don't think we get enough credit for is that we have a competitive advantage when it comes to licenses. We have the best license you can have in the United States, which is a national insured depository license. It allows us to take deposits. It allows us for those deposits to be insured. It allows us to lend those deposits, but also allows us to go into all these different businesses that fall under the category of banking or financial services. And so it's a huge advantage. We don't have to apply for a new license. We don't have to partner with someone on a license. We have the capability under our license. And because we're on the technology platform, we can enter it pretty quickly. And we'll do some really innovative things. We'll be able to actually have a marketplace for stable coins and have a marketplace for cryptocurrencies where we're crossing the transfer of certain fiat dollars to certain crypto tokens. And you can imagine how that could play into foreign exchange as well as just the conversion from dollars into crypto. Most people don't realize that when you operate with large crypto companies, they don't send fiat dollars, they send stable coins. So SoFi USD will be used for that, but our bank will also use all those different forms of payment outside of fiat.
Maybe I can dive a little bit deeper into that with regards to the crypto initiatives. In the Q4 earnings call, for example, Anthony, you mentioned, institutional crypto trading, stablecoin as a service, crypto-backed lending. It seems you guys are leaning fully into crypto. How big of an impact do you think crypto is going to be to the revenue mix once it's fully built out? Like how big do you think this addressable market is going to be for you guys?
Yeah, so I think there's two ways to think about crypto revenue. Well, first I'd say I think it will be very large, but there's two ways to think about its impact. Let's take the trading business. So investing in crypto, we charge transaction fees, we charge trading fees for that. But that business also generates revenue indirectly, just like our invest business does. Funny enough, in our invest business for equities, we don't charge any fees, but we generate revenue from payment from order flow and stock loan and other B2B revenue streams. Crypto will be the same thing, except we actually charge the consumer on a per trade basis. Crypto lending, great revenue stream that could scale to be quite sizable. BlockFi was a company that existed. You could probably see their financials online, but a really sizable revenue stream. We're already in lending. So being able to offer secured lending will allow people to borrow at lower rates than unsecured lending. And it's a really attractive business from a security standpoint because your credit risk is much, much lower because it's secured by these other assets. Now you have to know how to manage risk and your exposure, but that's what we do. So I'm excited about that. The institutional trading piece, I don't know that it will be that big of a revenue stream directly. I think it will be a big revenue stream indirectly. Think about SoFi Pay. We're charging people to use SoFi Pay. It's going to run on crypto rails. So that will create indirect revenue. And there's a lot of other ways we'll create indirect revenue, including big business banking, because we're offering crypto and crypto services. We'll charge for them, but that by itself, we wouldn't be in the big business banking business if crypto didn't exist. There wouldn't be a need, and if there was a need, it wouldn't be that differentiated without crypto.
Yeah, I like that a lot. And, you spoke about this a lot where there's these products and services, Galileo, maybe even that the full benefit is not just in the P&L, but also in the services and the product cadence that you guys have been putting out. But how should investors look at products like SoFi Relay, for example? This ended up showing off such a massive increase in total products, but it's not necessarily directly revenue generating. Is this something where you're collecting a lot of data and that's going to eventually lead to cross-sell to other products?
Yeah, it's a critical part of our strategy. It gives us the central nervous system. Without SoFi Relay, it'd be a lot harder for us to solve for the equation, spend less than you make and invest the rest. In order for you to get your money right, for you to reach your ambitions, you have to invest. Savings just let you get by. Investing lets you get ahead. And so we're solving for that equation, spend less than you make, invest the rest. If we have Relay and we have all of your checking and savings accounts attached to it and your credit cards and your mortgage and your other debts, we can then help optimize for you what you have to do in your life to solve that equation. What must you do to get there? So it does not drive revenue directly today. When we look at our P&Ls, we look at each business on a standalone P&L. And it's a pretty simplistic way. There's more complicated ways, but the way I love to look at it is what are the marketing dollars? What are those marketing dollars produced from a member acquisition standpoint? What's the cost per acquisition? What's the revenue that gets generated from that member with inputs? So like SoFi Money, their deposit level, their spending level, it builds it up at a micro economic basis. And when we do that for Relay, there is no revenue directly, but we do attribute to that P&L revenue from cross-buy. So that's how we justify what we spend on driving marketing in Relay. And the revenue stream for Relay is really a function of what we would have paid to acquire that second purchase of that other product. So someone comes in through Relay, they then cross-buy into a loan. That loan would have had a customer acquisition cost. We actually don't have a customer acquisition cost because we did it through Relay, but we take the assumption for that customer acquisition cost would have been and put it in the Relay P&L so that we don't underinvest in Relay. And oh, by the way, every P&L we have has both direct revenue and cross-buy revenue. So that we don't underinvest and then we allocate our resources. The second area that really is really important is AI, because we can use that data that we have from you to help answer questions that you have for us. So we're working on something called Coach. We've talked about in the past. Coach is meant to help you get your money right, spend less than you make, invest the rest. So if we have Relay and we have the data, like I'm using Coach now, testing it, how much did I spend in the last month? It literally has all of my spending across all of my accounts, all of my family's accounts in one view. And it's super powerful to have that data.
I'm just curious about the AI piece really quickly with regards to Coach, Anthony. Is the idea or the vision for AI to become fully proactive in your financial life? So to take actions on your behalf, perhaps unprompted, is that the end state? Or maybe how do you think about it at a high level?
I mean, it could for like perfunctory things like paying bills, sending money to a friend, splitting rent, things like that, simple, easy to do. Could it sweep your cash? It could. I mean, we have Cash Coach. It tells you how much cash you have everywhere. Again, if we didn't have Relay, we wouldn't know that. So I hit Cash Coach. It shows me how much cash I have in aggregate, suggests what I should use that cash for. So for example, if it's sitting in an account with no interest and I have credit card debt that's revolving, it says pay down your credit card and you'll get 25% return instantly because that's the interest rate that you're paying. So it absolutely can get there. But I wouldn't say that's the sort of value. I think the value is helping you make decisions that solve that equation. And whether those get executed automatically or manually by you, that's not important. It's the decision that's really critical.
Yeah. I wanted to also touch on another recent product. I kind of quoted 2025 as being like the year of SoFi Plus. And then just at the end of 2025, you guys made a massive change to SoFi Plus, starting the SoFi Plus subscription along with the SoFi Smart Card. Could you speak to sort of that new product line and the maybe diversification away from credit cards? Obviously, you've had some pretty critical things to say about credit cards in general and how the SoFi Smart Card plays into that and why potentially you guys are charging for this new product line.
Yeah. And maybe I'll answer a question with a sort of bigger focus on what are the things I'm specifically focused on in 26 that are most important. And SoFi Plus is one of those.
Please, yeah.
So as a company, we set priorities each year. We communicate them to the team. It's 5 or 6. The team then builds plans against those priorities. It's a critical step in making sure you're allocating your resources and managing your resources in a way that will maximize value. Then you hold people accountable. The number one priority for us, and it has been consistently for as long as I can remember, is continue to build the world's best culture in the world. We don't have the world's best culture in the world, but that's our goal. And that remains our number one priority. Specifically for culture, though, this year, I'm focused on prioritizing founders' mentality, making sure we're moving as fast as we possibly can, making sure we're not using resources inefficiently, we're not getting bloated, we're getting the market as fast as we can, we're iterating as fast as we can, and we're constantly getting better and staying ahead of the competition. I'll break out the next two things into two categories: new things and then existing things. So new businesses, or I would say nascent businesses. We already talked about crypto, huge focus of mine. And that includes both investing in crypto and SoFi USD and our stablecoin strategy, which I think, that could be something that's not really understood where we're headed. And I'm super excited about it and what it does for the entire ecosystem of SoFi, not just our products, but also the tech platform. We mentioned big business banking, which is something I'm really focused on as well. And then SoFi Pay, which is brand new. On existing things, the product experience is a huge priority. The more products that we launch, the more complicated our app is getting, our website is getting, and the more we have to use technology to make it a seamless experience so you can find whatever you want when you want it as fast as you want. The second thing is SoFi Plus. And SoFi Plus and Smart Card, I would say, are going to see continued iteration. And it's going to see continued iteration because we haven't gotten it right yet. I'm excited about what SoFi Plus can be, and I'm excited what Smart Card could be. I think we'll find the right formula for SoFi Plus before we find the right formula for Smart Card. And we'll do some things that will cause people to scratch their head, but just know what we're doing is based on data. And sometimes things you think are going to work, they don't work. And sometimes things you test that test a certain way, then you actually launch it, it doesn't work the way that it tested. So we're going to do a lot of iteration around SoFi Plus and Smart Card. So stay tuned. On SoFi Plus, I think you'll see us start to really experiment with the big value equation. One of the benefits of SoFi Plus is that a high percentage of our existing members use it. And what's more shocking, which I wouldn't have guessed, I hoped it would happen, but what's more shocking is that of our existing members that sign up for SoFi Plus and pay for it, 40% of them take out a third product. So in order to be an existing member, they have to have at least one product. They then sign up for SoFi Plus. And then after signing up for SoFi Plus, they take out a third product. And you say to yourself, why the hell did we have to launch SoFi Plus for that member to come out with another product, take another product? We already had the other product. We should have already made them aware of the other product. So SoFi Plus is a way to communicate to our existing members, there's a lot more for you to do. But we need a one big hook. We talk about Amazon Prime. When it was first launched, it was free shipping. And that was the big hook. But really what it did was it educated everyone about all the other products outside of books, music, and video that Amazon Prime was worth paying for, because you wouldn't have paid $99 a year for free shipping for just books. But you would if you're buying clothes and sporting goods and hardware, et cetera, et cetera. So SoFi Plus telegraphs to people there's more value here, but we need that big hook. And I think what you'll see us do is experiment with a couple of big hooks. And this will be pay for it types of things, but paying for it is instantly valuable, and you should pay for it because the paying for it actually gets a return instantly by what you're paying for. SoFi Invest is starting to gain real scale. And so it's something I'm really focused on to make sure we accelerate the momentum there. Credit card has been a product that we've iterated on. I'm personally involved with it, meeting on it every week, and we're doing a lot of different things. And I think you'll see us use our credit card as a way to help people get out of debt and as a way to build the rest of our business. But people will need revolving credit cards, and we'll provide that to them as well. And so there's some unique synergies there. And then loan platform, business credit expansion, and product expansion. And then on tech platform, 100% focused on our product roadmap and customer wins. There's just a lot of activity. The need for this service has been accelerating. We obviously lost a big customer there. That's unfortunate, but we're moving forward. The growth of that platform without that customer into the 20s, which is where we want it to be. And we'll have to lap the revenue from that. But we have a path forward. I'm excited about what we can do there.
Maybe I can ask just the complimentary on that. So you highlighted the individual product swim lanes, but I'm curious, recently you mentioned the path to 50 million members. Can you speak to the international expansion piece around that? So we talked about the product, the diversification. What about the international expansion?
Yeah, so the growth in our members that we've talked about has always been tied to just the US. So those goals, those aspirations are tied to US. I would say international 2026 will be a year in which we really work on coming up with an international strategy. We have an international strategy for the tech platform, but for the SoFi brand, which I think you're talking about, we only operate in Hong Kong today with the SoFi Invest business. We're launching SoFi Crypto in Hong Kong here very shortly. But we want to actually start to accelerate international investment. But 26 will be a year of planning, strategizing, and building a go-to-market strategy. Could we end up doing something in 26 that's beyond that? We could. SoFi pays in over 30 countries right now. If we could quickly put that into an international market just by itself as a payment app, that's something I would like to do. It's not definitive that we'll do it, but if we can find the resources and the path forward, that's something that could happen. But other than that, we're not going to jump into one of these international markets organically in 26, unless it's small like SoFi Pay. What I will tell you, SoFi Pay could be pretty dramatic on our impact of entering a market if it builds great momentum and virality. You
actually ended up talking about that. By the way, if you end up coming to Canada, you have a customer right here. So, but you've talked about disrupting payments a couple times, and that would be sort of, if you had unlimited amount of money, that would be a place that you would love to enter. What do you see SoFi Pay evolving into? Like, what does disrupting payments even look like to you?
Yeah, we want you to be able to pay any way you want, anywhere you want, anytime you want, at the lowest cost, the fastest speed, and the safest. And so, that's kind of we started with using Bitcoin, converting it to fiat to Bitcoin on the Lightning Network, and then the fiat on the destination end. SoFi USD will go into SoFi Pay. We have a bunch of other payment capabilities at the tech platform. We want them all to be in SoFi Pay. So, and we'll offer that as a service as well externally to other companies. My holy grail on it would be where we have code available for you to acquire through a website, self-serve, and you can put that code into your platform and leverage all the different rails that we've integrated into one solution.
That's really interesting. Really quick as well. There's been some concerns about essentially just you guys have grown personal loans so fast that there might be some saturation of the market, that you guys are becoming so large here. How do you look at the total addressable market of personal loans, and is there an ability to continue up this pace of growth? Obviously, with your 2028 guidance essentially looking to 30% growth over 3 years, there seems to be some sort of plan to continue this growth.
Yeah, no, the lending business is a great business. I think it's a competitive advantage. We have the highest lifetime value because of that business. I think of the personal loan market as the credit card market. So I think it's $1 trillion plus market. It's a great value prop. People pay 20 to 30% interest on their credit card. Our loans are, around 12%. So I think it's a great product. I think it's saving people money. It's getting them out of debt, amortizes down. I think it's a great solution. But we'll balance it. We want diversified growth. Like, our fee revenue will continue to grow. It's growing fast and will grow faster than lending. And there's a number of new businesses that we're getting into that have fee revenue. And there's many of our existing businesses. And as I mentioned, the big business banking is really a fee-based business. Tech platforms a fee-based business. Plus is a fee-based business. SoFi Pay and SoFi USD, fee-based business. Crypto, a fee-based business. Investing, as I mentioned, the B2B revenue streams are all fees. So we're going to diversify the company across different businesses and different types of revenue, but we're absolutely going to grow the lending business. I've been at SoFi for 8 years. We've lived through pretty much the broad spectrum of cycles. We've gone through a credit cycle. We've gone through an interest rate cycle. We've gone through a pandemic. We've gone through changes of administrations, a regulatory cycle because of the changes in administration. So we have a lot of lessons learned. Our credit's performing very well. We pull back if credit's not performing well. We've shown discipline to slow down growth if we're in an environment that says it's too risky. And similarly, we've shown the ability to step on the gas if the environment's really healthy and we're performing well. So, I like to say, give me the conditions. I'll tell you what businesses I'm going to grow. But hopefully, we stay very diversified so we can weather whatever storm comes our way. And, the student loan refinancing business has started to come back. We had a stronger quarter in Q4 than we had in Q3, and we continue to see strength there as well. And so that's diversification. And, you could imagine us starting to use crypto lending as a way to refinance other types of debt, not just take out debt. And so that will also be an element of this, which is less risk. So we don't always have to be focused on capital usage and risk on the balance sheet. Again, we want to maximize return on tangible equity. So that's a combination of some risk and some capital, and also businesses without risk and without capital.
I'm curious, Anthony, because you're mentioning fee-based revenue and it's become the majority of incremental growth. And it seems as though with loan platform business, crypto, and others, it's going to continue to do so. How does that diversification change the risk profile in the eyes of the market, and perhaps maybe have the market put a hybrid tech valuation on SoFi as opposed to like a traditional bank valuation? Do you think it's going to be one thing that does it, or is it just going to be a series of gradual small steps?
I think it's consistency. So every earnings call, we talk about durable growth driven by innovation and branding, driving strong returns. And so if we can drive, durable growth, 30+% revenue growth, 40+ earnings growth, financial services companies, traditional brick and mortar financial services companies, they just don't grow at that rate. They have to build buildings. They have to scale things. We have a technology platform that scales incredibly well, and we've proven that. And I know we're nowhere close to having saturated the market. If you look at our, our growth in members, 35+%, our growth in products, 35+%, our cross-buy up to 40%. We're getting great operating leverage. If we were starting to tap into the end of the market, our customer acquisition costs would be going up, our member growth would be decelerating, our product growth would be decelerating, cross-buy would be going through the roof because we wouldn't be growing the numerator, and we were just getting people to take out a second, third, or fourth product. So we're still very early in the marketplace, and I think the valuation of the company will come back to growth, which is a function of how do you drive returns. And our returns on tangible equity are going to be superior to others. We should trade at a really high multiple of tangible book value. I think if you do a PEG ratio, as I mentioned, of 1.1 times 40, you get to one of my favorite numbers, 44P ratio. Apply that to 2028 earnings, discounted by 12% back 2 years, and there's a lot of upside. So, I think if the durable growth continues and we can operate through different cycles, which we've done, we'll have that premium valuation. And it's just a matter of doing it consistently. It's not too long ago, our stock was $7.
Anthony, back whenever it was $7, this company seemed like a screaming buy to myself and to Tevis and many of the other retail investors. But also you were a buyer of this stock. We just recently saw that one of your executives made an insider purchase on open markets. Is there a possibility that even you are potentially looking at this stock as being undervalued and potentially looking to double down on your conviction?
Yeah, I think, as I mentioned, I think that the stock's undervalued, and I would be buying it here. This is publicly available. I did a prepaid forward, variable forward.
Mm-hmm.
I can't remember the exact time period, but I really can't buy or sell the stock without significant tax implications until March 1st. I think that's the time period. So, if March 1st was last week, I would have been buying the stock. Now, that doesn't mean when March 1st gets here, I'd buy the stock, because there are always factors that can cause me not to be able to buy the stock. If we're looking at an acquisition, even if it's not going to happen, it's like we're seriously considering an acquisition, I'm not going to go buy the stock. Like, I don't want to. There's a saying that says when you skate on a pond, you guys are from Canada, it's cold, I'm sure you've skated on ponds, you don't want to skate on the edges of the pond in the spring. Why? The ice is melting, it's softer, and you could fall in. I always want to be in the middle of the pond when it comes to things like buying the stock or otherwise. So if March 1st was, last week, I would have been buying the stock. I wasn't in possession of any material non-public information. There was nothing to block me out otherwise, and there's always things we have to check. But I would have definitely been buying the stock. And if it's still here on March 1st, and I don't have any reason that I can't buy stock, and I don't want people to think if I'm not buying stock, there's something going to happen. It just could be. I'm not clean of any type of risk in buying it from a securities law standpoint. So I think it's undervalued, and I'd be buying it. I couldn't be more optimistic about our outlook and our plan and our strategy. So, I apply that 44 multiple to future earnings and discount it back to today in my own mind, which is what I did on the prepaid forward. I think the high end of the prepaid forward I did was $49 in 3 years. And that was 6 months ago, I think, or 9 months ago.
Yeah. That's a ton of clarity, by the way. Thank you.
You're welcome.
I know we're sort of approaching time, and I really want to end on this question, because I really appreciate in this interview, also in recent months, the transparency. I know retail has been asking for more transparency on just even product updates, which you gave in a long thread at the end of last year, and the commentary and the call with regards to 2026 initiatives, and maybe dropping some names on the Galileo side of things. Like, all of these things are things that retail really appreciates, and even this interview. So what are your thoughts on more direct shareholder engagement going forward? I know retail investors have asked for maybe a shareholder day, but that's maybe far in the future. Like, what are the steps towards getting there?
Yeah. So, we've continued to build out our investor relations team. The team published something yesterday for the first time. Having been a research analyst for 10 years and then a banker, and having been a CFO, I come at this from, 3 different perspectives, and it's a great prism to be able to look through. And I don't want to, criticize any one party everyone has their views. My guess is their views are ethically driven. My guess is their views are very thoughtful, but they're just wrong often and many times misguided. There's opinions, but there's things that people talk about as if it's fact. And so, this whole dilution on the equity offerings, I'm reading it and reading it, and it's, driving me nuts. And I'm like, well, can I publish something? And then this is, not just this last couple of weeks, but all the way back in the fall. And, it's not great for a CEO to be publishing their point of view. And investor relations, that's their job, is to communicate on behalf of the company's points of view holistically, not just mine, but Chris's, our boards, our employees, and the realities. And so we will start providing perspectives the best we can. We want to be as transparent as we can. We can't always share every piece of information. Sometimes it's competitive. Sometimes we just don't want to take the risk of sharing that information because it may be misconstrued, or the reality may turn out to be different and there's too much risk with the outcome, et cetera. But we will communicate as transparently as we can. I'm pushing the team hard on answering the questions that people have that are unanswered, but also providing a perspective that may be different than others so that the world has a better view. I believe markets are efficient if you give them transparent information. So my goal is to have our company be valued as fairly as it can. That won't happen without more information and transparency. And so we'll provide it. I will say, one thing I'll say that will probably be controversial. I asked one of our team members on the investor relations team, I said, some of these analysts are using a different valuation for every company. Like, they use this valuation for the company they don't like, and they use this valuation for the company they do like. And if they actually use that methodology on our company, we would actually have more upside than the company they're recommending. And having been that person, I'm like, that's crazy. And they get away with it. And so I said to the team, I want you to go through the research analyst reports, and I want you to apply the valuation. I want you to look at all the companies they're looking at and how they value each company. And then say, what if they valued SoFi that way? Most of the people that are, super bearish on us with these crazy low price targets, they would have us a buy if they actually applied the same valuation methodology to us as other people. Some want to do it on tangible book value, and they're like, well, it's like a bank and its returns aren't 20, 30%. So they want to put 2 times book value on it. That's just self-serving. That's not taking risk. That's not helping their customers, their clients. Like back in 2000 and 2001, it was really hard to value Amazon, but we came up with a valuation technique of PEG ratio using the 4-3-year growth rate, applying it that PEG and PE to the 3 years away, discounting back to today. People challenged it and said, hey, you're using a 12% discount rate. You should be using a 25% discount rate. Or I don't believe the growth rate. Or I don't believe the earnings. Those are logical, good examples. They're researchable examples. But not acknowledging the growth rate of one company versus the next is just idiotic. So we're going to start actually publishing our point of view, and maybe even have our own point of view on someone else's research. Why shouldn't we? Like, at the end of the day, we got to stand up and defend our company. We have a right to, make sure we're driving shareholder value. That may require us to tell people you're wrong, or this is an inconsistency, or you're not using the same standards. This is ethically not even correct. So anyway, I went a little bit of a soapbox there. Something I'm passionate about. I'll tell you this: I do 1 out of 100 things I think of when I communicate on Twitter or other places. If I post something, that's 1 out of 100 things I wanted to say, but refrained from saying. And so our investor relations team will hopefully provide more transparency for everyone to make the best decisions they can make. At the end of the day, my goal is to help people make the best decisions they can. And I want them to make the best decisions they can, because if something goes wrong, then at least they had all the information, and the earnings turned out to be different. The growth rate turned out to be different, as opposed to someone completely missing it, going from $7 to 30 because they just refused to try anything that was out of the norm or more, less orthodox. So anyway.
I love that. I think it needed to be said.
just really quick on the people that did trust you and have been following your vision for years and years, like myself and Tevis, that did buy at 7 going up to 30. I know a lot of people who have gotten very wealthy off of the execution that you've had while being the CEO of SoFi. So just from me and Tevis and the rest of the retail community, I just want to say thank you.
Well, thank you. That means the world to me. And, I appreciate all the people that fight in our behalf, and we want to prove you guys right. And the sad thing is, it's not that we don't want to prove other people wrong. We want them to be right too. And it actually bothers me if someone's saying something about our company and I know they're going to be wrong. So anyway, thank you guys for your support and all those shareholders out there that have trusted us. It's been 8 years. I feel like we're just getting started. I don't want to do anything else other than what I'm doing. And I feel like the opportunity is still in front of us, and it's day one. So thank you.
Fresh horses, Anthony.
Yeah, absolutely. Who
Thanks for
dares?
your time.
Thank you, guys.